All right, let's dig into Accel Entertainment's latest earnings call. The company put up some solid numbers, a real beat, but the market's reaction? Kind of quiet. So we're going to unpack exactly why that is.
So let's get right to the headline number, the one everyone was watching, adjusted earnings per share. Accel came in at 24 cents, which sailed right past what Wall Street was expecting. A clean 4-cent beat. Not bad at all. But, and here's the real head-scratcher, despite that beat, the stock barely moved, just a little bump of 2.1%. So the big question we're asking today is, why the lukewarm reception for what looks like a pretty good quarter?
To figure that out, we've got to pop the hood and take a look at the key financials. The numbers tell the story.
And you know, what's really interesting here is just how solid everything looks. Revenue ticked up just ahead of what people were thinking, almost $330 million. That's up over 9% from last year. Adjusted EBITDA also saw that nice double-digit growth. Now that GAAP EPS number, wow, up over 170%. But you gotta know, that was helped along by an accounting change. It wasn't all pure operational magic. Still, the key takeaway is simple: solid growth any way you slice it.
So what's actually fueling these results? Well, it's really a two-part story, making their main business even better while also expanding into new areas. You can see right here, the business is built on a really strong foundation. Their core markets, Illinois and Montana, are absolute cash cows. We're talking 82% of all revenue. That's the stable base that lets them go out and fund all their new growth projects.
And this is a great snapshot of their strategy in action. I mean, in Illinois, they're not just sitting back. They're getting smarter, swapping out weaker spots for ones that make more money. At the same time, their new bets are starting to pay off. Louisiana is scaling up really nicely, and their new racino at Fairmount Park already growing month over month. And then you have this efficiency push with new tech like the TITO system tying it all together. It's a smart playbook.
Okay, let's pivot to the balance sheet, because this is where management is really setting the stage for the future. For investors, this part of the story is super important.
So this is huge. This refinancing deal is a game changer. They've locked in a new $900 million credit facility. What does that mean for you? Well, it means they push their debt way out to 2030, they're paying less for their capital, and they've basically given themselves a big war chest for growth and buying back stock.
But having a war chest doesn't mean you go on a spending spree, right? This quote from Mark Filan on the earnings call was really telling. Someone asked about those giant company-changing deals, and the message was crystal clear: we're not going to overpay. Patience is the name of the game right now.
And this chart just lays out that whole M&A strategy perfectly. On one hand, they're actively on the hunt for smaller, bolt-on deals that help them get bigger in key places like Louisiana. But for the huge, transformational deals, they're happy to sit back and wait for prices to get more reasonable. It's a really pragmatic, two-speed approach.
So let's put all the pieces together. What does this all mean for the stock? And what are we going to be listening for on the next earnings call?
Here are the big things we're keeping an eye on. We need to see that growth in Louisiana continue. We want more details on Fairmount Park. How seasonal is it, and what's the plan for Phase 2? We'll also be watching to see if that new Tito tech actually helps their margins. And of course, can they close some of those smart bolt-on deals? The real wild card, though, new legislation. If a state like Pennsylvania opens up, that could change everything.
Which brings us right back to where we started. The quarter was good, the strategy makes sense, but the stock didn't really react. It feels like the market is saying, okay, that's great, now show me more.
And for that exact reason, we're rating Accel Entertainment a market perform. Look, the company is doing a good job. They're executing well, but it seems like all that good execution is already reflected in the stock price.
So here's our thesis in a nutshell. The good news, the strong operations, the better balance sheet, it's all priced in. The market already knows. So unless some big new catalyst comes along, we expect the stock to just trade sideways for a while, probably bouncing between about $9.90 and $10.50, which leads to a trade idea. If you're an investor looking to generate some income from a stock that's not moving much, a covered call strategy could be something to look at. You own the stock, you sell some call options against it, and you collect that premium while you wait for the next move. But of course, as always, this is not financial advice.